Hello everyone, and welcome back to Colin Investing. Today, we're diving deep into the complex interplay of the U.S. economy, recent market reactions, and some significant sector-specific impacts that are shaping the investment landscape. This isn't just about numbers, it's about understanding the story behind those numbers, and more importantly, what it means for your portfolio. We're going to unpack a lot today. We'll be dissecting the latest inflation data, examining the Federal Reserve's stance, and exploring how Trump's tariff policies are sending ripples through various industries. We will also be checking some specific companies like Meta, Tesla, and Intel. So, buckle up, because we're about to embark on a comprehensive journey through the current economic climate. Let's get started. So we've set the stage with a broad overview of the current economic climate. Now, let's really dig into the numbers that sent shockwaves through the market. The January CPI report. And believe me, this wasn't just a minor tremor. This was a significant jolt. The headline number, core SPI, that's excluding food and energy, rose 0.4% month over month. Now on an annualized basis, that puts us at 3.3% increase year over year. Both numbers exceeding expectations. Remember all that talk about inflation cooling down? Well, this report throws a bucket of cold water on that narrative. Specifically, the numbers were higher than the projected 0.3% MUM and 3.1% YO. But let's not just focus on the overall figure. Let's dissect where this inflation is coming from. Massive chunk, a full 30%, was driven by housing costs. We're talking about rents and owner's equivalent rent continuing their upward climb. This isn't a new trend, of course, but the persistence of this housing inflation is what's really worrying the Fed. And then here's the curious case of the eggs. You might have noticed this at your local grocery store. Egg prices are through the roof. We're talking about a staggering 15.2% surge in just 1 month. That's the biggest jump we've seen since June 2015. There are a few factors at play here, including avian flu outbreaks that have impacted supply. The result? It's impacting the CPI print, and it is impacting people's wallets. I mean, 2/3 of food price increases come from eggs. Understandably, the market's initial reaction was, let's call it unpleasant. Futures immediately dropped. Bond yields spiked. A classic sign of investors anticipating a more hawkish Fed. It's a knee-jerk reaction, but it reflects the very real concern that persistent inflation will force the Fed to keep interest rates higher for longer. We will check what's Powell's take on this later. So, the market throws this curveball with the CPI data, right? Everyone's bracing for impact. But what's the real story from the Fed's perspective? That's what we need to understand. This higher than expected CPI print, it doesn't exactly help the Fed's case for cutting rates anytime soon. In fact, it does the opposite. It reinforces the cautious wait and see approach. Remember, they've been saying all along that they're data dependent, and this data point screams caution. And the market, it immediately started to recalibrate. Traders who were previously optimistic about a rate cut perhaps as early as September pushed those expectations all the way back to December. Some are even pricing in the possibility of only one 25 basis point cut for the entire year. That's a significant shift in sentiment. Now Powell, in his recent remarks and testimonies, has been very careful, very measured. He's emphasizing that the Fed is more focused on the PCE, the Personal Consumption Expenditures Price Index, as their preferred inflation gauge. He basically said, look, CPI is important, but PCE is what we really pay attention to. Why? Because PCE, they argue, provides a broader, more accurate picture of consumer spending and inflation trends. But here is the kicker, and this is where it gets even more interesting. Powell also dropped a subtle but very important hint about the potential impact of, you guessed it, tariffs. He acknowledged that these trade policies, particularly Trump's proposals, could influence the Fed's decision-making process. Imagine a scenario where tariffs push up prices across the board. That adds another layer of complexity to the inflation puzzle, and it's something the Fed has to factor in. They can't just look at PCE in isolation. They have a dual mandate and various factors to consider. The tariffs play a big role. So the bottom line here, the Fed's in a tough spot. They're navigating a complex landscape of stubbornly high inflation, shifting market expectations, and the looming specter of trade policy changes. It's a delicate balancing act, and the CPI data just made that act a whole lot harder. So, we've seen the market's initial, almost visceral, reaction to the CPI data, and we've heard Powell's measured, almost cautious response about focusing on PCE, but what else did Powell have to say? It is more than that. He testified before Congress, and this is where things got even more revealing. He directly addressed the elephant in the room, or perhaps I should say the elephants in the room, CPI and those looming tariffs. He reiterated the Fed's commitment to data-driven decisions, emphasizing the need for vigilance. He said, and I find this crucial, we won't overreact to one or two data points. This is key, folks. It signals a commitment to a broader, longer-term perspective, not just a knee-jerk response to the latest headlines. But, and there is a big but, beyond the expected discussion of inflation and monetary policy, something else came up. Something that's been generating a lot of buzz, and it might surprise you. Cakewalk. Specifically, and pay attention here, Powell stated that the Fed is not prohibiting banks from engaging in crypto activities. I will say it again, the Fed is not prohibiting banks. That's not a green light for a full-scale crypto free-for-all, of course, but it is a notable departure from the previously, let's call it, ambient stance. It's more than a subtle nod. It's a potentially significant shift. Now, you're probably asking, what does it all mean? Well, consider the context. We've got Trump and his family increasingly involved in the crypto space, which we'll touch on later. We've got major financial institutions, like some big banks, expressing a growing interest in offering crypto services, if regulations allow. Powell's statement suggests that the regulatory door might be creaking open just a bit. It hints at a potential future where banks traditionally wary of crypto might start to embrace it more openly. What will happen? We will keep an eye on this for sure. So we've seen the Fed's tightrope walk, balancing inflation concerns with a surprisingly nuanced view on crypto. But here is another major force at play, one that's sending shockwaves through the real economy, far beyond the halls of Congress or the screens of Wall Street traders, and that force, of course, is Trump's trade policy, specifically his proposed tariffs. Imagine you are a CEO of a manufacturing company, right? You're trying to plan your production, manage your costs, and stay competitive. Suddenly you are hit with the prospect of significant tariffs on essential materials like steel and aluminum. How do you react? What do you do? The uncertainty alone is crippling, and this isn't some hypothetical scenario. This is happening. We're already seeing the immediate impact. Midwest's aluminum premiums, that's the extra cost buyers pay on top of the base metal price, shot up 25% in a matter of days. Think about that. A 25% jump almost overnight. That's not a minor fluctuation, that's a seismic shift, and the reaction, it's been swift, and it's been allowed. Companies like Ford, and this is just one example, are actively lobbying against these tariffs. They're sending their CEOs to Washington, practically begging for relief. Why? Because, as they're saying, these tariffs are leading to cost increases and widespread chaos in their supply chains. It's not just about higher prices for consumers, though that's certainly a concern. It's about disrupting entire production processes, creating uncertainty, and potentially derailing investment plans. Ford's CEO is said to have gone to Washington twice in 3 weeks. That must tell you something. But perhaps the most vulnerable sector, and this is something we really need to pay attention to, is energy. The energy sector is heavily reliant on steel and aluminum, from pipelines to drilling equipment to renewable energy infrastructure, and a large portion of those materials imported. We're talking about 40% of the materials used in oil and gas pipelines coming from overseas, with 16% specifically from Canada and Mexico. Without those imports, energy costs are almost certain to rise. This, ironically, could undermine Trump's own stated goal of controlling inflation. It's a complex web of interconnected consequences, and the long-term effects are still very much uncertain. The American Petroleum Institute is also warning about this, saying the consequences could be far from expected. So, we've talked about the broad impact of tariffs, especially on sectors like energy, but the ripple effects are far-reaching, aren't they? And that's where the semiconductor industry comes into play, a sector already facing its own unique set of challenges. Imagine you are an investor following this sector. It is crucial to understand everything, right? The proposed tariffs on semiconductors. They're not just a minor inconvenience. They represent a significant threat to the entire industry. We're talking about potentially disrupting supply chains, increasing costs, and ultimately impacting the availability of everything from stamps gigs to data centers. It is important to notice that it is not a new problem, but there are new discussions that make investors worried. Now, the stated goal of the Trump administration, and this is something we've heard repeatedly, is to boost domestic chip production. It sounds good on paper, right? bring manufacturing back to the U.S., create jobs, reduce reliance on foreign suppliers. But, and here is always a but, the reality is far more complex. Building cutting-edge chip fabrication plants, the kind that can compete with the likes of TSMC, is no simple job. It takes years and billions of dollars. It's not like flipping a switch, and this leads us to an interesting, almost paradoxical situation with Intel. You'd think with all this talk of boosting domestic production, Intel would be perfectly positioned, right? A US-based chip giant ready to step up and fill the void. And in fact, the market seemed to think so, at least initially. Intel stock surged. On these policy expectations, we're talking about the biggest three-day increase since 2001. A massive jump, fueled by the hope that Intel would become a major beneficiary of these tariffs. But hold on a second, let's not get carried away by the hype. If you dig into Intel's actual performance, specifically their foundry business, the part that would be directly impacted by these tariffs, the picture is far less rosy. Their recent numbers, not exactly stellar. In fact, they've been struggling to keep pace with competitors, even as we all know that demand for chips has been soaring. What does it mean? We have a lot to consider, but for sure, it is not all good news. The conclusion: we can expect it to be a big debate, a big drama. So we've been navigating this complex landscape of economic indicators, Fed policy, and the looming shadow of tariffs. But the market, as it always does, throws us some curveballs, doesn't it? It's not just reacting rationally to data. There are patterns, almost quirk emerging, that smart investors need to be aware of, and that's where these market anomalies come into play, and they reveal something fascinating about the current psychology of investors. We're seeing what some are calling a weekend effect, and it's almost counterintuitive. You'd expect the market to be, relatively consistent throughout the week, right? But what's actually happening? A significant pattern of selling on Fridays, followed by buying on Wednesdays. It's like clockwork, or perhaps I should say to clockwork, given how unusual it is. Fridays are down, investors want out, Wednesdays they want in. But why is that? Well, the prevailing theory, and I think it's a pretty solid one, points directly to, you guessed it, Trump melms specifically. It's investor anxiety over his tendency to make major policy announcements, often through social media over the weekend. Think about it. You're holding a significant position, and you are worried about waking up Monday morning to a tweet that could send the market into a tailspin. What do? Many investors, it seems, are choosing to de-risk on Friday, just in case, get out while the getting's good, so to speak. Then by Wednesday the dust has settled. Whatever news came out over the weekend has been digested, analyzed, and priced in. And that's when bargain hunters, or perhaps those who simply feel the initial sell-off was an overreaction, step in to buy. It is, after all, historically the best day to buy now. I am not saying to build an entire strategy with that, but it's a fascinating illustration of how political uncertainty and even the timing of announcements can create these short-term trading patterns. It's a reminder that the market isn't just about fundamentals. It's about psychology, and it's about fear, anticipation, and the collective behavior of investors reacting to those emotions. And there is more. Not only we have this weekend effect, but also, if we consider the S&P, we have that the last 2 weeks of February have had negative returns, historically speaking. Does it mean it will happen again? Not necessarily, but it is an interesting data point to have in mind. So, we've explored the macroeconomic headwinds, the inflation data, the Fed's cautious stance, the ripple effects of Trump's tariffs. It's a lot to take in, I know, but amidst all this uncertainty, there are pockets of remarkable growth, driven by, you guessed it, artificial intelligence. And that's where these two companies, Upstart and AppLovin, come into the picture. Their recent performance offers a fascinating glimpse into where smart money might be flowing, and why and what happened. Both companies reported earnings, and the market loved what it saw. We're not talking about modest gains here. We're talking about significant stock surges. Upstart, a lending platform, soared. AppLovin, a mobile advertising and gaming company, also saw a big jump. These weren't minor bumps. These were major leaps of faith from investors. Now, the common thread, the underlying driver of this excitement, both Upstart and AppLovin are leveraging the power of artificial intelligence to fundamentally transform their respective industries. Upstart is using AI to revolutionize loan approvals, moving beyond traditional credit scores to create a more accurate and, they claim, more equitable lending process. AppLovin, on the other hand, is using AI to supercharge its ad targeting, delivering more relevant ads to users and, crucially, better results for advertisers. Let's dig a bit deeper into Upstart. The revenue up a staggering asterisk 56% asterisk year over year. That's not a typo, 56%. And what's driving that growth? Primarily loan volume. People are borrowing, and Upstart's AI-powered platform is facilitating that borrowing at an impressive scale. Their AI models are constantly being updated, refined, and improved. It's a continuous learning process that's giving them a competitive edge. They are even planning an AI day to show investors and analysts. That is how important it is for them. And then we have AppLovin. Their revenue jumped 44%, which is a lot. And they are not stopping there. They are not satisfied. They announced a bold move to expand beyond their core mobile gaming market and into the vast and lucrative world of comms and even television advertising. Think about the potential there. They're essentially saying, our AI-powered ad targeting works incredibly well for mobile games. We believe it can work just as well, if not better, brace for online shopping and even traditional television commercials. It's a big, ambitious bet, and the market is clearly taking notice. But here is the broader takeaway, and this is crucial for understanding the current investment landscape. The market, right now, seems to be favoring companies that are in the AI allocation layer. These are the companies that are taking AI technology and applying it to solve real-world problems, creating tangible value, and, perhaps even more importantly, these are companies that are relatively insulated from some of the macroeconomic risks we've been discussing. They're not directly impacted by steel tariffs, for example. A slowdown in interest rate cuts might not significantly dent their growth trajectory. They're operating in a slightly different sphere, driven by the specific and powerful dynamics of the AI revolution. We still have to remember that, although things look good, there are also big competitors, so it is not a done deal. So we've seen how AI is powering impressive gains for companies like Upstart and AppLovin, seemingly defying the broader market anxieties. But what about a company that's already a household name, a tech behemoth? Let's shift our focus to Meta, a company that's been on an absolute tear. We're not talking about a slow, steady climb here. We are talking about 18 consecutive days of gains. 18 days. That's practically unheard of in the volatile world of tech stocks. It's the longest winning streak for a Nasdaq 100 component ever since the index's inception. That's enough to make even the most seasoned investors a little dizzy and a little suspicious. Now, you might be thinking, great, time to jump on the bandwagon. But hold on a second, let's dig a little deeper. Let's look at a key indicator that might suggest this rally is, well, let's just say it's getting a little frothing. And that indicator is the put-call ratio. For those less familiar, the put-call ratio is essentially a measure of market sentiment. It tells us the proportion of investors betting on a stock going down, buying puts, versus those betting on it going up, buying calls. A high ratio suggests more bearish sentiment, a low ratio more bullish sentiment, a very high ratio. It often indicates that a stock is oversold, that pessimism has gone too far. People are too negative. But what about Meta? Its put-call ratio is currently sitting at 0.802. That's the highest it's been in 6 months. And the total open interest, the sheer volume of options contracts, is also elevated. What does this tell us? It suggests that, while the stock price keeps climbing, a growing number of investors are quietly, discreetly, buying protection. They're buying puts, not necessarily because they think Meta is going to crash, but because they want to lock in those incredible gains. They're essentially saying, I've made a lot of money, and I don't want to lose it if this thing suddenly reverses course. I will put it in another way. It means people are betting more on Meta going down than on it going up. Think of it like buying insurance on your house. You don't want your house to burn down, but you buy insurance just in case. It's a prudent move, especially after an unprecedented winning streak. And that, my friends, is a sign that even the smart money is starting to get a little cautious, a little nervous about how much longer this Meta rally can last. It's a classic sign of a potential top, though not a guarantee, of course. We've just delved into the whirlwind of market reactions to AI-driven successes and potential downturns signaled by investor behavior. Now, let's shift our focus to a company that's always a lightning rod for discussion, no matter what the market conditions. Tesla. I'm sure most of you have an opinion about this one. After a period of decline that had many investors questioning its near-term trajectory, Tesla finally saw a rebound. But, and this is a crucial but, we can't just assume this is a full-blown trend reversal. We are not there yet. We need to be discerning, looking for specific signs that distinguish a temporary bounce from a genuine sustainable shift in momentum. It is important to note that the situation remains fluid until we see a decisive break above certain key levels, which we'll get to in a moment. We have to treat this, for now, as a potential turning point, not a confirmed one. I know many of you are eager to know if it's time to jump back in, or perhaps increase your position. And understandably, no one wants to miss the boat if this is the start of a major rally. But remember, patience and careful analysis are key in this market. So what are we looking for? What's the telltale sign? The magic number, if you will, is $350.51. That specific price point represents a critical level, and how the stock behaves around that level will give us significant clues about its near-term direction. Let's keep an eye on this one. We will keep checking the signals for now. Let's consider it a temporary increase. We will change our minds if facts suggest so. We've just seen how the market is reacting to AI and how some companies are doing even in challenging periods. But the AI world is not the only place where money is moving. Let's shift gears and talk about something that's been bubbling under the surface for a while now, the increasing involvement of the Trump family in the Kaikusuk space. And no, this isn't just about tweets or offhand comments. We're talking about tangible business ventures, strategic investments, and a potential reshaping of the financial landscape first. Let's be clear. The Trump family's interest in crypto is growing. It's not a passing fad. It's a deliberate, calculated move, and it's happening on multiple fronts. There are various signs of it. Tech, for example. WLF, a Karakoid platform with close ties to the Trump family. This isn't some obscure fly-by-night operation. WLF recently launched what they're calling a Strategic Token Reserve Program. Sounds fancy, right? But what does it mean? Essentially, they're diversifying their holdings, investing in major tokens like BDI and Ethereum, and aiming to, in their words, enhance market stability. Whether that's the real goal, or whether it's a clever way to capitalize on the volatility of the crypto market, is of course open to interpretation. What do you think? But it doesn't stop there. The Trump family also holds a majority stake in a social media and streaming company. And guess what? That company is also exploring crypto-related financial services. They're looking at integrating crypto payments, potentially offering crypto-based investment products, the whole 9 yards. It's a clear signal that they see Kiko not just as a speculative asset, but as a potential core component of their business empire. It is important to remark that they claim none of the family is directly involved in WLF to avoid problems, but the connections are there. We've just seen how the market is reacting to AI and how some companies are doing, even in challenging periods. But the AI world is not the only place where money is moving. Amidst all this talk of established companies and predictable trends, let's shift gears and talk about a wild card, a company that's been on a roller coaster lately, Supermicrocomputer, or SMCI. I'm sure most of you have an opinion about this one. Now, the stock has been exhibiting a very volatile behavior. We're talking major swings up and down, the kind of volatility that can make even seasoned investors a little queasy. There have been ups and downs and ups. But why? What's driving this erratic behavior? Well, part of the story is right here. The company released preliminary financial results, and frankly, they were weak, ma'am. Not exactly the kind of news that inspires confidence. But, and this is a big but, tucked away in those same reports were projections for 2026 revenue that were surprisingly strong. Much stronger than anticipated, a classic case of mixed signals, creating a tug-of-war between short-term concerns and long-term optimism. And then here's this. MCI currently has no auditor. Let that sink in for a moment. No auditor, that's like flying a plane without instruments. It raises serious questions about transparency and financial controls, and as a direct consequence, several of their financial reports have been delayed. The market hates uncertainty, and this situation is practically a textbook definition of uncertainty. It is not a good look, no matter how you see it. What will happen? We will keep an eye on this, for sure, and that brings us to the end of today's deep dive into the markets. We've covered a lot of ground from the inflation data and the Fed to Trump and the specifics. I truly hope you found this breakdown helpful, Justical, and maybe even a little bit entertaining. If you did, please show your support. It means the world to us. Hit that like button. It really does help the channel grow and reach more people who are passionate about understanding these complex market dynamics. And of course, if you haven't already subscribed to Callin Investing, we're constantly putting out new content, analyzing the latest trends, and providing perspectives you won't find anywhere else. We want to build a community of informed investors, and we'd love for you to be a part of it. Finally, I want to hear from you. What are your thoughts on the market? What questions do you have? What companies are you watching? Don't be shy. Leave a comment below. Let's get a conversation going. Your insights, your questions, your perspective, all valuable. Let's learn together and navigate these markets as a community.